Yesterday, we discussed how the Federal Reserve's main goal is to engineer a soft landing for the US economy by bringing down inflation while also avoiding a sharp economic downturn. Well, last night, the US second quarter GDP data was released, and it turned out to be better than expected. The second quarter GDP accelerated at a faster pace, reaching 2.4%, surpassing economist predictions and even exceeding the 2% growth rate recorded in the first quarter. Now, this report indicates that the US economy remains resilient despite the Federal Reserve's aggressive rate hikes. Now, the rise in GDP can be attributed to various factors, including increased consumer spending, non-residential fixed investment, and state and local government spending. Now, one significant point that caught our attention was consumer spending by Americans. Spending grows at a 1.6% rate, slightly slower than the first quarter, but still solid. A considerable portion of this growth came from spending on services such as vacation travel, restaurant meals, and even entertainment like Taylor Swift tickets. Now, the latest GDP data reaffirms that the US economy is in good shape. There's also low unemployment and continued strong job creation. Additionally, inflation has also been cooling down, which is a positive sign. Now, despite these economic indicators, there are concerns about the sustainability of the growth as the short-term economic outlook remains uncertain. Now, the Federal Reserve has already implemented multiple interest rate hikes to control inflation, and the US economy now faces risk due to tighter monetary policies and also challenges in the global economy. As we discussed yesterday, the Federal Reserve is no longer predicting a recession in 2023. However, they're still anticipating a noticeable slowdown in growth later this year. The Reserve Bank of India has taken some aggressive steps to tackle soaring inflation, leading to substantial interest rate hikes. From 4% in July 2022, the rates were hiked to 6.5% by February 2023. Now, when interest rates are high, non-banking companies end up paying more for their debt, like loans, and this significantly eats into their earnings, leading to higher financial cost. Now, amidst the announcement of Q1 earnings for fiscal year 24 by Indian companies, rising interest rates have become a major challenge for corporate earnings. According to a Business Standard study on 271 listed companies, excluding banking and financial sector and IT sector, the combined interest rate expenses rose by a staggering 36% compared to the same period last year. This is the fastest pace of rise in interest expenses in the past 3 years. Now, this rise in interest burden in the past year has also negated a large part of the gains to Indian companies from a decline in commodity and energy prices in the period. The interest burden, however, is lower than that in the pre-pandemic period. The interest expenses as a percentage of sales in the pre-COVID period of 2019 was 3.6%. Now, the ratio then declined sharply in the early post-pandemic period due to a decline in interest rates and deleveraging by many companies. Since the interest rate hike cycle began in April 2022, interest expenses as a percentage of sales has risen and now currently sits at 2.83% in the current quarter. Now, one key takeaway from this is that even though the raw materials and energy costs have cooled, interest expenses are still causing trouble for non-banking companies. Having said that, once inflation cools down below the RBI's tolerance limit of 4%, and with the decline in rate hikes by the RBI, this trend could reverse. With that, this is me, Merlin Sudana, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com